A soaring stock market, soaring inflation, up and down interest rates. What do we make of it all as 2021 comes to a close? And more importantly, what does it mean for investors like you? Hi everyone, I'm David Scranton, and thank you for clicking on today's video. In September, the stock market had its first losing month since January. But since then, Wall Street has rebounded to new record highs, even though many of the issues that worried investors in September remained worrisome through October and into November. How will it all play out in the final weeks of the year? And what can you do to prepare? I'll answer those questions and more on today's update show. We'll cover the reasons behind Wall Street's recent roller coaster ride, the inflation factor, best and worst case scenarios for the rest of the year, as well as the smartest move that you can make before New Year's. And we'll also talk more with Jeff Small, president of Arbor Financial Services, and Jon Najarian, co-founder of Market Rebellion, as well as Mike Burleigh, president of Peak Capital Management. But first, let's start with some recent market highlights and the reasons behind them. As I mentioned, September marked Wall Street's first losing month since January. All three major indices finished down around 5% for the month. But by late October, the Dow, S&P 500, and NASDAQ had all hit new record highs again. And the rally continued into November, with the Dow topping 36,000 for the first time ever, actually on Election Day. The market then cooled a bit the following week, but just a little bit, only to start its way back up again. So what inspired all this optimism after September's swoon? Well, that's a great question. The economic data that emerged in October was mixed at best. Third quarter GDP growth came in at just 2%, which is a big drop from the over 6% growth achieved in quarter one and quarter two of 2021. Meanwhile, supply and labor shortages continued, and they continued to fuel inflation, which actually hit 6.2% in the month of October on an annualized basis, and this being the biggest year-to-year jump since 1990. And what's more, long-term interest rates continued to rise for most of the month, with the yield on the U.S. 10-year Treasury bond hitting almost 1.7% on October 21st. On the other hand, investors have also seen some hopeful signs. New coronavirus infections dropped nearly 60% in October, and several important economic indicators improved, including unemployment and consumer confidence. And after that early autumn spike, long-term rates leveled off and then started falling again. And what's more, at its November meeting, the Federal Reserve indicated that it will not start raising short-term interest rates again until it's sure that the time is right. The Fed also re-stressed that it will move cautiously with its plan to wean the economy off all the artificial stimulus that it's been getting since the coronavirus crisis started last March. All these factors have actually helped keep the stock market at or near record highs in recent weeks. But the question becomes, could the inflation factor dramatically change all that by year's end? Well, that's another good question, because for most of the year, inflation has been just about the only thing capable of rattling Wall Street. Rising prices tend to worry big investors. Why? Because they know that if prices rise too high, consumers may reduce their spending, and this in turn could reduce corporate profits. At the same time, they know inflation could also force the Fed to raise short-term interest rates sooner rather than later. And if that happens, it could also push up long-term interest rates and could possibly put a crimp on borrowing. And of course, if spending and borrowing both drop, could that bring the whole recovery to a grinding halt? Well, more good questions. However, I believe the more urgent question for everyday investors is this. If prices keep going up steadily as they have been, will the stock market start going steadily down? Or even worse, could more bad inflation news or some other factor trigger a fast sell-off and maybe a market correction, even if it is only 10 to 20%? Well, obviously, that could represent a pretty bad scenario. But what about a best case? Well, even though GDP growth fell dramatically in the third quarter, it's expected to rebound in the fourth quarter to about 5%. And if so, that would give the US economy its strongest year of growth since 1984. Even better, many experts expect growth to continue into 2022 as the economy shifts from recovery to expansion. In a best case scenario, big investors will focus on these forecasts and hopefully then share that optimistic outlook. Because if that happens, we could see the stock market surpass its recent record highs. And with the S&P 500 already up 26% this year, that would give Wall Street its third straight year of well above average growth. So with all that in mind, here's the smartest financial move I believe that you can make in the next few weeks. Look at your investment statements, look at the markets, and then think back to March of 2020 when the stock market dropped by about 40% when the coronavirus crisis first started. Were you a nervous wreck back then? Did you think, I don't ever want to feel this way again? Did you vow to lower your investment risk only to forget about it once the markets recovered? If so, remember that feeling now and take action. If you've already shifted your strategic focus from growth to income, then talk to your advisor about how you might modify your allocation to stay in the income world but lower your risk just a bit. On the other hand, if you're already investing for income and you realize that you weren't nervous during the coronavirus sell-off, you might want to talk to your advisor, if your risk tolerance is appropriate, about getting slightly more aggressive but staying in the income world. The fact is, a 10 to 20% market drop could actually be a good buying opportunity for investors with the right risk tolerance using the right income-based stock market strategies. And of course, if you're within 10 years of retirement or already retired and haven't yet shifted your investment focus from growth to income, from growth to interest and dividends, I believe that is the smartest financial move that you can make right now. And that can start with one simple phone call. And now let's welcome today's guests. First of all, my good friend, Jeff Small, president of Arbor Financial Services in Melbourne, Florida. Jeff, as usual, great to see you.
It's great to be back, Dave.
And also today's guest, Jon Najarian. He's co-founder of Market Rebellion, and he's also co-author of the book, Follow the Smart Money. Jon, it's so great to have you back here on The Income Generation.
Great to be back with The Income Generation. I love it. Thank you.
Jon, we're talking about stocks and the markets today. That's a huge topic because the market is so overvalued right now. And if we go back to Stock Investing 101, every investment is really the present value of all future cash flow. And I know you remember that. But for our audience's benefit, has the market lost sight of that because values are so high?
Absolutely. And I don't need to show you a better example than Rivian. And it's a stock, Jeff, that I bought, but it's an electric vehicle manufacturer. Of course, they're trucks, and it's a good-looking pickup truck. Everybody's tastes are different. The Lightning by Ford also looks lovely. I don't know so much about the Cybertruck over at Tesla, but Rivian has no sales, but they have a sexy product. They don't have a dealer network that's going to take most of the money from the sale of the vehicle, and they don't have the legacy costs. So people are definitely, Jeff, looking beyond the normal metrics for measuring what a company is worth and saying, well, the reason I can pay such an extraordinary PE, if there's not even any P yet for those earnings, is that the future revenue stream is going to be so great. This is the future, these electric vehicles. And so that's why you get a crazy valuation like that.
Well, they've always said, Jon, the market's irrational, but boy, that just takes the cake. I mean, talk about irrational. It makes no sense. $140 billion market cap on Rivian and no revenue yet. That's craziness.
Yep. But, it's a brave new world, and we're just lucky to be living in it, I guess.
But Jon, if you get out of that sector of electric vehicles, do you feel like in many of the other parts of the market that market participants are suffering from that dreaded word FOMO, fear of missing out? Or do you think that things are still relatively rational in other areas?
Well, it's a great question because you've got a stock like Apple, and there's clearly not a FOMO in Apple right now because it is actually one of the underperformers on the year, even though it's over 150 a share. It's made money this year, a lot of money, but it's not one of those stocks that's just zoomed to the upside. Like, for instance, some of the cybersecurity stocks, some of the software companies that have come out that have just crazy FOMO. But when that fever breaks, it breaks hard. Just look at Snowflake, SNOW. When that one broke, it cut the valuation, dramatically. And so I would always, as you guys would, caution investors about trying to steer themselves away from that fear of missing out and instead make that a very small part of your portfolio, not a very big part.
Sure, and it's funny, you and we both agreed toward the beginning of this year that there'd probably be a good solid 10 or 15% pullback before the end of the year, which would give us a buying opportunity. And of course, September, I was getting excited thinking, oh, this is it, this is great. We didn't really get to that 10 or 15%. Things took off again. So is that the best buying opportunity we're going to see year to date or between now and the end of the year, do you think?
I think so, although there are a number of stocks that will start seeing that tax loss selling. And as you guys know, it's no longer T+3 for that, meaning that it has to settle before you get to recognize the loss. There are a lot of stocks that will be sold into year end so that people can match up some of those losses with some of the big gains they've got this year. So depending on how big a wave that particular tax loss selling is, you could see a sector or two really come under some heavy pressure. But for an awful lot of the other sectors like energy, that's just been like this, or banks that have also been like that, I think you're wise to hold on through the year. I don't think you get that 10 or 15% correction from here through December.
So, John, has the Fed gotten it wrong? Because now they're tapering. There is a correlation between when the Fed stimulates and the markets rising and asset prices rising. I thought they were kind of aggressive. I don't see them raising rates next year, but have they gotten it wrong at this stage since we have really 2% less workers than we did pre-COVID today with all of the stimulus?
Yeah, I do think they've got some of it wrong. They said they wanted to let inflation run hot for longer. They have done just that, Jeff. So I'm not surprised that we're seeing a 6% inflation at the consumer level and a pretty high level at the producer price as well. I think that means that they're behind the eight ball. So I don't think it's going to be nearly as transitory as they thought. And we still, to your point, do not have a lot of workers back. To get them back, you're going to have to see a significant wage inflation. We've talked about that great resignation. And an awful lot of folks have just said, you know what, I'm not working for that money anymore. I've kind of discovered that if I budget and stay home and live off unemployment, I can do that and have a better life than spending an hour each way commuting and then paying a significant portion of what I earn to the government. So I think I'll just stay at home. To get those people off of that model, you're going to have to see significant wage inflation. And that's why I say it's not transient or transitory. This is going to be something that's with us well through 2023, maybe all the way to 2024.
John, are you seeing signs of stagflation out there? I mean, I'm starting to feel to some degree like it's a little bit like the 1970s again, except that, I could imagine that it's going to be this long, but I'm starting to see some stagflation, which is never good.
You could see that if the Fed really gets aggressive now, for a host of reasons, Dave, not the least of which is, of course, we've piled on the debt, both under President Trump and now under President Biden. He's accelerated that debt. We have to pay that back. And obviously, we never really pay it back. Instead, we just pay the interest, which is what those bonds are. That's the interest on the debt. And I think that just if they start moving rates up too fast, that will cause that stagflation that you're talking about. Right now, we're just talking about taper. So if Jeff's right and we don't see a move to increase rates in 2022, that'll be a good thing, because there's obviously a lot of liquidity that is brought just by the Fed buying bonds. And when they taper, they're buying fewer and fewer bonds as they taper. If all of a sudden they go to an interest rate increase, I think that's when you get that stagflation. And that's what many of us hope does not happen.
Yeah, you've been around long enough to know that in the past, the Fed has often been both the arsonist and the fireman. They get to take credit for putting the fire up, but a lot of times the missed timing is what actually caused it. Of course, that's easy for us to say from the cheap seats, right? So you mentioned this national debt, and of course, therefore the concern that taxes are going to go up dramatically, especially if they get the next 2.5 or 3 trillion approved. So how much of a negative effect do you think that will really have on the stock market over the next 2 or 3 years?
I'm certainly hoping that we do not get that very, very significant 2 trillion or 2.5 trillion. They're talking right now about 175. They're not going to pay for it with what they've talked about, guys. You know that. I know that. We can do basic math. That's why they were coming up with ludicrous ideas like, what if we tax billionaires or people centimillionaires and so forth on unrealized gains? In other words, you haven't sold that stock, but it's gained a significant value over time. We want to tax you on the gain there. Again, those kind of games, that would be terrible for the stock market. It would be terrible for individuals. And so I'm hoping they pare this back significantly. Yeah. And hopefully it's a lot closer to 1 trillion if it even passes. And keep in mind, that's over a decade. So I think we could handle that amount of additional debt and the interest payments on 100 billion a year. Mm-hmm. But if it gets into the 300-400 billion a year, I don't know how we do that.
That's a lot. John, real quick, 2022, positive year or negative year for the S&P 500? What's your best crystal ball say?
Negative.
Negative year.
The end of the year, negative, because interest rates and energy prices, which are just going whoop, 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 are going to be things that are a drag on the economy, and that'll have to be passed on to the consumer. We're already seeing it. It's going to be worse next year, I think. But that doesn't mean I'm looking for a huge drop, maybe 12% next year. Yeah. So you'll have to be nimble.
Yeah. And if you're retired or close to retirement, you're counting on that money. Keep one finger on the trigger, but it doesn't necessarily mean to get out of the game today. Jon Najarian, Jeff Small, as usual, my pleasure. Thanks for being here on The Income Generation.
Thank you, guys.
Thanks, Dave.
Let's get a financial advisor's perspective. I want to bring in Mike Burleigh, president and founder of Peak Capital Management, a retirement income store located in Stuart, Florida. Mike, always great to have you here with us.
Thanks for having me, Dave.
So what has surprised you about the stock market so far in 2021?
Well, it's continued run. I would be thinking at this point, the market's getting a little long in the tooth. We've been running really since 2009 with a few minor corrections, but just the continued growth in the market has kind of surprised me a little bit.
So when have you become more cautious? And I don't mean philosophically, because you're always cautious and protective with your clients' money, but I mean, we crashed through the record highs, I believe it was last August, only August of 2020, only a few months after the beginning of the coronavirus crisis. So when between the beginning of the crisis and now, did you start to become a little cautious, thinking things are getting a little frothy?
I think we're getting to that point now with inflation kicking in. We really don't know what the taxes are going to look like. There's just a lot of variables out there. So I would say, looking into next year, we could get another year run out of this market, but I would start to be very cautious next year. If I was someone who's looking to retire in the next couple of years, I would probably be looking at maybe reducing my risk if I'm all in the market at that point. You just don't have enough time if we do get a correction to recover. If you're looking to retire in the next 2 to 3 years, you really have to kind of take a look at your portfolio and say, well, what do I look like if we had a 20, 30% market correction? And would I have enough time to recover from something like that?
So, Mike, do you think most investors that are part of the income generation are feeling a little cautious or concerned now as you are? Or do you think a lot are suffering from that dreaded word acronym FOMO, fear of missing out?
I think they're getting a little more cautious. It's funny what we hear in meeting with clients and prospective clients is they're concerned about the debt, all the government spending. They're concerned about taxes. They're concerned about inflation and the effects that could have on the markets today. So I don't think it's the fear of missing out anymore. I think it's more of just trying to maintain what they've accumulated and live off the interest and dividends they've accumulated at this point in their life without having to change their lifestyle.
Well, I hope you're right, and I hope the common sense is kind of kicking in where people are thinking about these types of things more. But then again, some people are thinking, well, inflation. You mentioned that earlier. Inflation is going wild, right? So I need to be in the stock market. I need to be in growth because inflationary concerns. So what do you tell people when they mention that to you?
Well, you need to have a balance. I don't advise getting out of the stock market altogether. I mean, you want to have a hedge against inflation, sure. But, Dave, you got to realize, we haven't had inflation like this in 30 years? Mm-hmm. You've got a whole new generation of people coming up that really have never experienced this, right? Mm-hmm. So you think about inflation, what does that really do? Well, you go to the gas pump, it costs you an extra $20, $30 to fill up, right? You go to the grocery store, it's an extra $50 a week to buy your groceries. A lot of people have automatic deduction on a lot of their expenses. The pet food goes up 10, 20%. So at a certain point, that's going to start to affect people. Maybe not, in the next first quarter, but maybe second, third quarter of next year, if this thing keeps running like it is, that's going to start to affect people and they start to throttle back. So what kind of effect that has on the markets and you combine that with the taxes, we don't know where that's going to look like next year. So there's just a lot of things going on out there where I would be cautious at this point.
Yeah. Well, people struggle from, recency bias. Whatever they've experienced most recently is what they think will happen in the future. And you're right, if you have a generation of folks that haven't seen high inflation or haven't really lived through it at a time in their life where it's meaningful, right? If you saw high inflation, but your parents were paying the bills, I guess that doesn't really count as much, right? But when you go to the pump and you see those prices going up, that's a whole different deal. But you talk about keeping some money in the stock market as an inflation hedge, but that doesn't mean that you have to stay growth-based. You can still stay in the market, get some upside potential, and have a significant income flow, have a significant dividend yield.
Absolutely. If you invest more for maybe what we call value, where you can, generate a nice dividend on your stock portfolio, maybe you can pull 3-4% dividends on a value stock portfolio. That's going to give you a hedge there, and you still have some upside potential for the growth. So rather than just be in momentum or growth stocks, make that transition to more value.
Sure. And it's funny, you mentioned the things that could knock the market off its perch, and you mentioned inflation. But I think even though probably the most conservative people think that by 2024, inflation will get back down to some normal rate. So in that sense, even if it's 3 more years, it's still reasonably short term. You mentioned the taxes, and that's a big part of it. But how about the Fed? Isn't it true that historically the Feds, they're like the firemen, the arsonist and the fireman. They've created as many recessions as they've actually fixed. And if that's the case, what's the risk of that happening again and the Fed getting it wrong?
Well, that's the ultimate risk, isn't it? They seem to be more reactive than proactive many times. But there's a lot of bright people up there, but they're walking a fine line. It's not an easy thing to do. So, they get this wrong. I think they could send us into a recession in 2023.
And for those watching this video that haven't lived through the 70s, they may have heard in the history books this term stagflation. And one of the things that we're seeing right now is signs of possible stagflation, which is simply defined as where the inflation rate is growing up faster than the GDP, than the actual economy. So you're getting high inflation, but you're not getting growth that exceeds it. It's one thing to have inflation if the growth exceeds it, right? But in the 1970s, we had inflation that exceeded growth, and we're starting to see signs that that could be happening now.
Yes. Yeah. So just very cautious. You have to be very cautious next year.
Yeah, yeah. So if you're going to be in the market, have one finger on the trigger. Wait for it. Maybe if you're if you want to be more aggressive in the market, maybe buy the dips. If you're doing it in an income way, like you said, a higher dividend value approach. Any final words of wisdom as we start to get into this holiday season here?
Well, looking forward to the Thanksgiving holiday. Feel like I have a lot to be grateful for. If you're ever feeling a little down, just sit down with a pencil and pen, make a little gratitude list. That'll be a mood adjuster for you.
Great words of wisdom, great advice as usual, Mike Burleigh. All right, thanks so much for being here with us on The Income Generation.
Hey, thanks for having me, Dave.
Thanks for watching today's market update video. If you enjoyed it, please click the thumbs up button, give us a like, and make sure that you subscribe to our YouTube channel for new content each and every week.